Hey everyone, welcome back to Corporate Decoder. Today, H.E.L.I.O Corporation filed a Form 8, and I am seeing a debt settlement that could be a turning point. Quick note, this is not financial advice, just my take on public filings for educational purposes. H.E.L.I.O is settling a significant debt using stock sales, and the terms are quite interesting. This filing is a standard current report, what we call an 8K. It is for reporting major events that shareholders should know about right away. Think of it like breaking news for a company's stock. The big news here is H.E.L.I.O Corporation, or Helio has agreed to settle a debt of $879,163 with someone named Sean Wolf. This debt comes from two promises to pay, basically loans, that the company took out in late 2024. One was for $400,000 and the other for $500,000, both with an interest rate of 9.75%. That is a pretty high interest rate, so it is no wonder they wanted to get this settled. Now, how is Helio paying this off? They are not handing over cash directly all at once. Instead, they've agreed that Sean Wolf can sell Helio stock to get the money. This is often called a leak-out agreement. It means Wolf will sell shares gradually over time, and the money he makes from those sales will go towards paying off the debt. The company might also make some direct payments, but the bulk of it seems to be tied to stock sales. This is where it gets really interesting and potentially concerning for existing shareholders. There are rules about how many shares Wolf can sell each day. He can sell up to 4,000 shares if at least 20,000 shares are being traded that day, or he can sell 12% of the total shares traded that day, whichever is larger. This is designed to prevent a massive flood of shares hitting the market all at once, which could crater the stock price. Let's look at this from a historical perspective. Companies that have large debt settlements paid through stock sales, especially smaller companies like Helio, often see their stock price under pressure. For instance, when companies have gone through similar debt to equity swaps, it can signal financial strain. It is like saying, "We don't have enough cash right now, so we're giving you a piece of the company instead." This adds more shares to the market, which can dilute the value of existing shares. And there is a kicker. If Helio stock gets listed on a major exchange like the Nasdaq or New York Stock Exchange, or by the 5th of July of 2026, Wolf's selling limit jumps to 25% of the daily trading volume. That is a significant increase and means he could potentially sell a lot more shares much faster, putting even more downward pressure on the stock. Whether Helio can get listed on a major exchange like Nasdaq or NYSE is a big question, and it is something they've been working towards as suggested by recent news about participating in investor conferences and having an advisor review their Nasdaq or NYSE readiness. Adding to the potential supply of shares, Wolf is also supposed to get 275,000 shares from a Joseph Pittman. These shares will also be subject to the same selling rules. So in total, Wolf seems to be gaining access to a significant number of shares that can be sold into the market. The company is also taking steps to make it easier for Wolf to sell. They are removing the restrictive legend from 225,000 shares almost immediately. This legend usually means there are restrictions on selling those shares, so removing it is a crucial step for Wolf to be able to cash out. And as usual with these filings, they list the exhibits. The most important one here is Exhibit 10.1, which is the actual settlement agreement in the form of an email exchange. This is where all the fine print lives. The market cap for H.E.L.I.O Corporation is around $57 million, with only 10 employees. This indicates it is a small company, making the debt settlement and potential stock overhang even more impactful. Any significant selling pressure from these settled shares could be very damaging for a company of this size. This situation is reminiscent of companies that struggle to manage their debt and resort to dilutive financing. Historically, small companies that go through multiple rounds of debt being converted into stock often face significant challenges in maintaining their share price. About half of microcap companies that do a reverse stock split, which can sometimes be a response to low stock prices often associated with such debt issues, end up delisting. While this isn't a reverse split, the increased share supply is a similar concern. Looking at the broader picture, H.E.L.I.O has been active in trying to boost its profile with investor conferences and roadshows, aiming for an uplisting to Nasdaq or NYSE. This debt settlement could be a necessary step to clear the decks before such a move. But the method of settlement also creates its own set of risks for current investors. What is my take on this? H.E.L.I.O is clearly trying to resolve a pressing financial issue. The settlement itself is a positive move towards getting their debt under control. However, the way this debt is being settled through stock sales is a major concern. It introduces the risk of significant share dilution, which could severely push down the stock price, especially for a small company. The increasing sales limit tied to potential exchange listing adds another layer of concern. The biggest risk I am watching is the market's reaction to the increasing supply of shares and whether Helio can successfully navigate this without a severe stock price decline. What I am actually looking for is evidence that the company can grow its business and generate enough revenue to avoid needing such dilutive settlement methods in the future. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, and subscribe if you found this helpful, and join our Discord community linked below.